This is Secure Radio, and our guest is Gregg PACITTI. Gregg PACITTI is a certified financial advisor. Gregg, welcome to Secure Radio.
Hello, Sekou. Thanks for having me.
Today, thanks for being our guest. We'll talk about uh, financial planning. Before we start, Gregg, can you please introduce yourself just to the general listener?
Sure. Yeah, like you said, my name is Gregg PACITTI. I'm a certified financial planner, and I am also the president of Ranch Capital Advisors, which is a wealth management firm in Sarasota, Florida. I've got over 20 years experience doing planning and investing with the markets, and have owned my own business for over a decade now, I guess.
Good. Gregg, there's many people out there who do not know how to manage their money, and how we start when somebody comes to you said, for example, I would like to have a plan. I would like you to organize a financial plan for me. What's the first step?
Yeah, that is the first step, and it's really the most important step that a lot of people overlook when it comes to planning is actually taking some time to sit down and really get clear about what you're looking to accomplish. And that's really what a financial plan is. A financial plan, when someone comes in to sit with me, we look at their current, what are they already doing in regard to their finances, and then what is their long-term goals. If they would like to retire in 20 years, or maybe they're already retired and they need to build, they need to create income from those investments. We typically have two types of clients. You have someone who's working towards what we call financial freedom, where financial freedom is when you get to a point where you've built up enough assets that you no longer have to work, in a 9-to-5 job if you don't want to. Now, if you want to, a lot of people like to continue to work, but it's really building up enough wealth so that work becomes an option. And then we have another set of clients that have already made it there and have achieved financial freedom, and they're looking to then create income off of those assets. So you're either turning income into assets, or later you're turning assets into income. But it's really sitting down and getting a very clear picture of what you'd like to accomplish. Just like anything in life, when you write it down, you create a plan. You look at where you're doing well, where you have some weak areas, and design a plan that you can follow. And that's the first step, and then you get into action.
Okay. So it's fair to say that second step is budgeting. So budget.
Yeah, a budget is I tell you what, everybody hates to do a budget. It is something that people dread, even though it's really not that difficult to do. But for some reason, people don't like to, take the time and see, well, where is my money going? And a lot of times they don't want to know, right? It's easier just to, not really focus on it and look it right in the eye of where is my money going to? But the people who have created wealth, some of the top millionaires, really start with a budget and they're actually pretty frugal people because they know where their money is going. They know where, you have to write down how much are you spending on food, on clothing, on shelter, and just some of your basic fixed expenses. And then you have another category as to how much are you spending on discretionary stuff. If you're going out to restaurants or travel or, boats or cars, things like that, where you get a very good understanding of where your dollars are going to. And the reason that's so important is because what we're trying to accomplish, especially when you're building wealth, is to free up cash flow, that you can turn that extra cash flow into more assets, and that's the name of the game. But if your expenses are so high, no matter how much income you earn, you won't get ahead. And so I know a lot of people who make really good income, but they end up spending it all. And so at the end of their career, or they haven't amassed enough wealth to actually be able to retire because they end up spending so much. And so it's really important, and I can't stress that enough, as when you're doing a plan, is get a good idea of where your money is going. And you can either do that on a piece of paper and with a spreadsheet, or there's so much technology now with apps that you can use, and you can link up your bank accounts and credit cards and really track where your spending is going, and know your numbers, because that's the first step, is like really getting a clear look at what are you already doing and where can you improve on your spending habits.
Okay, let's move to the third part. My third question will be putting money away, planning for retirement. And you hear a lot of different type of retirement, 401k. Can you school us on when to put the money away, where to put it?
Yeah. Now everybody's going to be different, but some of the most common ways to invest, some of the easiest, and that's the key, is make it easy to invest. And when I mean make it easy, is that you want to have something that's more automatic. Like so, a lot of people will start with, if their company has like a 401k or a retirement plan that you can contribute every 2 weeks, like from your paycheck. And so there's two reasons for that. One is it's easy, and you don't have to think about it. So you're paying yourself first before it goes into your bank account. You're paying your retirement account first, and so that way you don't have to have the temptation of spending it when it goes into your bank account. Two is that you get a tax deduction for that contribution. So any income that gets put into the 401k, you are not paying taxes on that money. So it gives you a tax break, which ultimately, again, puts more money in your pocket. And then the third reason for starting with the 401k is most employers will match at least some portion. A lot of them will match up to 3% of your salary. So that's just free money, and it's an automatic, 100% return on the money that you're putting in, up to that 3%, if that's what their program is. So 401ks are the best place to start. And then once you've maximized that out, you can look at other options like a Roth IRA or an individual IRA, or you can even, where a Roth IRA you don't get a tax deduction, but it grows tax-free. An IRA is something, if you don't have a 401k, or if you make under a certain amount of money, you can do both a 401k and an IRA. It's your own individual retirement account. And then finally is that you can just invest money in a regular after-tax brokerage account where you don't receive a tax deduction, but it's similar to as if you were just putting money in a bank as far as taxes go. But you can buy stocks, bonds, mutual funds, and have just a normal taxable brokerage account where you would pay taxes on capital gains or dividends and interest, just like you would pay taxes on interest in a bank. But so when you put a plan together, that's where you would start looking at where's the best place, the best type of investment vehicle to actually put my additional cash flow away and invest. And so when you put your plan together, you'll be able to look at all the options, and that will be based on your company you work with, your income that you have, and then how much you'd like to put away or how much you can put away. So all those things will factor into that decision.
Yeah. So which which one of these are more advantageous? 401k, regular IRA, individual IRA, Roth IRA. Can you school us about these different variables?
Sure. Well, the 401k will allow you to put more money away. So with the current rules, um, it's a little over, I think it's 18,500 you could defer in 2019. If you're over 50 years old, you can actually do even more, like an additional like 6,000. So it allows you to put more away. Like an IRA, it's limited. So you can both an IRA and a Roth IRA are limited to 6,000. So now there's also new, just recently changes over the last few years that some of the 401ks are allowing you to do a Roth 401k where you don't get the tax deduction going in, but it grows tax-free, and then when you pull it out down the road, all the growth, everything you've earned over those years, everything that comes out of it is tax-free. Where a traditional 401k, you get a tax deduction going in, and it grows tax-deferred. And when you pull it out at retirement, and you don't have to pull the whole thing out, but you just pull out what you need to live off of, it is then taxable. So whether it's better to do a Roth 401k or a traditional 401k, it typically depends on your income and what you expect your income to be later in retirement. If you can do both, sometimes you can do 50-50 split. That may be a good idea as well. I mean, I'm always a big fan of having as much in tax-free accounts as you possibly can, with the expectation that potentially tax brackets will be higher 15, 20 years from now than where they are today, which is pretty low historically. So they're both, it's the main thing is just putting the money away. So that's step one. That's the number one priority and the most important thing. And then number two is figuring out what's the best way to, either Roth or tax deferred or traditional brokerage account. And that will, again, depend on your situation. So you would know that either it's better to get a tax deduction now and pay taxes later, or don't get a tax deduction now and have tax-free income later. So they're both good options. And again, focus on actually putting as much money away, and that's more important than whether it's tax deferred or if it's tax free.
Good. Percentage of money to be put away. How you advise people on the percentage to put away?
Yeah, that's a great question. I mean, there are some rules of thumb of putting 15% of your income away. So if just picking any kind of number out there, 15% ends up being a pretty good number to choose. But let's say you're starting later in life investing, or let's say you want to reach that financial freedom before 66 or 65. So that's where a plan would come in, because you can really work backwards and say, all right, well, I want to retire at 60, and I need, I'd like to live off of, whatever dollar amount a year. If that's, 100,000 a year, or 200 or 50,000. That's, you back into that number based on how much time do I have, and then how much, am I able to put away. So the rule of thumb is 15, but if you can do 25, if you can do 30%, then you're just going to achieve your goals that much faster, and you'll have a lot more options, and not have to work if you don't want to. So again, it's different. It's just how focused do you want it? How focused can you be? How quickly do you want to amass wealth? And so those are always decisions. Is I can spend more today on things that I may enjoy, more discretionary things today, or well, maybe I'll tighten my belt a little bit and go without some of those, you know,